Hey, Keith, let me ask you about tariffs real quick, too, because I think, tariffs were a big part of what happened with silver, supply squeeze and all that. Was there a tariff effect in gold either last year, with so much gold being flipped from Switzerland to the United States and out of Canada and into out of Canada? Did some of that tariff trade make a difference in the gold price on the way up? And does that maybe account for some of the softness in gold prices, maybe back even into January a little bit, as I hate to call it tariff trade, but I think that's kind of what it was, maybe unwound a little bit earlier in 2026 for maybe some of the accounting for some of the softness. I mean, you said gold was due for a correction, or at least that was at least consistent with what we're seeing. Is maybe that was that tariff trade part of it?
You certainly could have gotten people that were buying gold out of fear of tariffs, like, okay, if I buy it now, I'm not going to pay the government who knows what percentage tariff rate. If I wait a month, it could cost me a lot more, so let me buy now. But by and large, the trade for tariffs for gold and silver was, and classically, this is the arbitrage, right? Is buy spot, sell futures. Now, spot happens to be a London market, which most of the time doesn't really matter, and futures is the New York market. And so to do that trade, you have to be able to, depending on how the price of the futures contract is settling out at the end, you may actually want to deliver the metal. So you're buying metal in London and you have to deliver it to New York, which is in normal times, that's fine. But then Trump says it can be tariffs. Right. So first he said it right after the election, even before he was president. Then it was like, okay, there isn't going to be tariffs. And then again, sometime that spring, a year ago, it was like, oh, we are going to actually tariff it. And the Treasury Department issued some clarification that it will be tariffed. And so that trade was back on. And so that trade is, okay, you're long spot, you're short futures, you have to get the metal into New York because if there's a 20% tariff, I mean, you're in a trade to make 1% and 20% tariff is going to kill you. So it was basically move a heck of a lot of gold out of London storage into New York storage is really what the trade was. It wasn't the US government importing it because they're going back to a gold standard, which is one of the ridiculous, absurd rumors that were going around. It wasn't a speculation. It was traders saying, okay, I'm in this carry trade because there was a nice healthy spread, unlike what there had been for years and years. With higher interest rates comes a wider spread on a lot of things, including gold carry.
Just to be clear, sorry to interrupt. Just to be clear, if for people who aren't familiar, the carry trade means you're selling the futures price to basically fund your long position in the London market. So
Yeah, you
when
buy
prices
spot.
go up, you're making money every which way you can.
It's not a price trade, it's a spread trade. So you
Right.
simultaneously buy spot and sell futures because the futures price is higher than spot. So if you can lock in 1% for doing that, that's just free money.
That's your carry.
Right. So you're in it for the carry. And then the thought that it would cost you 20% to bring in and deliver to New York would kill you. So solution is just move the gold bars over. I
Move it
thought,
ahead of time, right? So everybody's demanding to go move it into New York, even if you don't really need it in New York. Move it now as fast as you possibly can, just in case Trump changes his mind.
just in case there's going to be a tariff, which he said there was going to be, then he said there
They
wasn't.
said there
And
was. You
then
never know. That's the thing. It's so unpredictable. That level of uncertainty is just it makes everything much more difficult.
yeah, it's a huge amount of friction. There's a chilling effect on business. And the damage for these things, you may not even see it for a year or two, and it's durable for decades. So the New York market as a hedging market has been reduced, diminished in attractiveness. And now there's a market in Singapore, there's a market in Hong Kong, all kinds of other things are springing up. There's other markets springing up in other parts of the world. I don't know if I can speak about them yet. Just to solve this problem that, look, you're just trying to trade the carry. You don't really want to be held hostage by geopolitics of US tariffs. So what it does is it pushes the US out of the global trade, makes us more of a backwater, all the things that are the opposite of what they say was the whole purpose of it. But anyway, so you saw this huge accumulation of inventory in New York, which none of the gold bugs wrote about because according to their thesis, it's not really true, but according to their thesis, that should be bearish. And then they start writing about once there was clarity, there isn't going to be tariffs on gold and silver, the inventory begins to move back. There's a reason why it was in London in the first place. It was more efficient to be there. And so all the forces are pulling it back. And you can see the inventories are going down. You have the biggest inventory drawdown in 40 years, 50 years or whatever. And so it's bullish. Well, right. So it was bullish when the inventory accumulated. It's bullish when the inventory is being decumulated. It's always bullish all the time, that is the drill. But that was why the inventory was moving around. And it wasn't on speculation. It was just carry. That's all it was. Were there people that were buying, as I said, retail in anticipation of tariffs? Yeah, maybe some dealers may stock up a little bit more, figuring that if there's a 20% tariff, they get a 20% windfall on the metal. At the margin, sure, you probably get some people doing that kind of stuff. But
So
big
you're
institutional
saying there's
money.
probably not much of a price impact from the carry trade and having to move inventory. So it maybe wasn't a major factor in 2025 and therefore 2026. Just to
Not
clarify.
from the inventory move per se, but you might have had some speculators at the margin who thought this is a good time to buy gold, to own
Okay.
it rather than carry it. So if
Right.
you're a dealer, right? So these dealers, They really should be hedged, in my opinion. And that's a four-letter word to them. But, because if the price is going up, it's fine, right? You buy gold, then you sell it at a higher price, you buy more, even higher price, you sell it at an even higher price than that. But if the gold price is going down, the dealers get killed. But anyways, what's the old expression from, was it Scarface? Get high in your own supply. So they, they might have thought, okay, if there's going to be a 20% tariff or whatever the number was supposed to be, buy a bunch of gold now, stock up, and then when there's a tariff imposed, they'll be able to sell their gold 20% higher and have this gigantic windfall, which is much greater than the normal profit margins. Were there some that were doing that? Probably. Should they have been doing that? If they had asked my advice, no, they shouldn't have. And did it work out for them? Obviously not.
Right.
But I'd say in general, no. The tariff stuff, dislocates the industry players. It just adds more friction to business. It creates more risks. But it wasn't really a price mover, in either direction.
So it was a lot more noise to try to have to wade through to find some relevant signal. Because that's, I mean, again,
Yeah.
that's one of the reasons I'm having you on here is to try to clean up some of this stuff because we heard all sorts of stuff. I mean, when gold was going up, as you're pointing out, I mean, everybody had a story, everybody had a narrative. Gold's going up for this and gold going up for that. Now that it's softened, there's a million different narratives there as well. But let's talk about, okay, so the Iran conflict is negative for gold prices. Are we really looking for an end to the crisis? Is there a way for gold to go forward, assuming that maybe this lingers on for a while? Because I think this is a complicated story with Iran. I don't think this is going to be over with. I've been saying from the very beginning, this was not 6 weeks or a couple months. The Iran-US conflict is going to go on for quite some time because there's some really substantial issues that need to be hammered out and maybe literally hammered out with exchange of fire and warfare. Is gold kind of just stuck here until Iran gets off of the radar and we can move forward? Or is there a pathway for gold to recover even if Iran is still a major issue?
You could see the gold price fluctuating with the prospects for peace, even during March and April. And so gold is funny that way. I mean, it doesn't really correlate with anything, but for short periods of time, you can see it correlates with equities or anti-correlates with equities, correlates with interest rates. So there was a time when it was correlating with prospects for peace. And so in the next bomb, gold price would drop 2.5%. The next, hey, we're going to have peace. There's a ceasefire being proposed, and
2 weeks
it goes up
from now, right? The ceasefire is done. 2 weeks. Just give us 2 weeks, and then 2 weeks later, and then 2 weeks, and then 2 weeks, 2 weeks.
Right. But I do think that all of and by the way, our data shows the supply and demand relaxed. Supply became looser, demand became weaker through the course of all this compared to what we're seeing through end of 2025 and the first part of January 2026. So definitely physical market conditions changed, whether due to the war or other factors, but you can definitely see that. That said, the fundamental drivers for why gold is in a bull market, really post-COVID, on and off, and then, more recently, the last 2 or 3 years, the drivers are all still in place, which is rising distrust of governments, rising distrust with good reason for paper currencies generally, a rising belief in, monetary shenanigans. Hopefully I can finish it before it's overcome by events. An essay on the dilemma of the new Fed Chairman Warsh and his dilemma, right? So his boss wants them to lower interest rates. That's 100% clear. That's not a secret by any means. By the Fed's own theory, which is a wrong theory, but that's a whole different matter. They should be hiking interest rates to try to address inflation. And he's, caught in the middle of that and, the politics of all that. I'll say when, not if, interest rates resume their long-term falling trend, because I think those forces are only building up strengths. When interest rates begin falling again in a serious way, I think that'll be a heck of a catalyst for a rising gold price. The gold price doesn't particularly correlate to interest rates. In years past, we've looked at, in our annual market outlook report, we've looked at the gold price correlated against Fed funds rate or T-bills. We've looked at, 10-year treasuries. We've looked at so-called real interest rates, inflation adjusted. It just doesn't really correlate. But at the moment, I think falling interest rates, would be a gigantic catalyst, war or no war, for higher gold prices. And one reason, which is perpetually true, is that outside of monetary metals, where you do actually get interest on your gold, there's an opportunity cost to owning gold. That opportunity cost is the T-bill rate. As you're holding dollars, you can make the T-bill rate. And in dollar terms, it's risk-free. So why not? And so if that's 4% and gold is 0, there's a 4% opportunity cost. If that slams back down to 0, the opportunity cost goes away. It's one more reason, one more plus in the gold, column, and, the absence of a plus or a minus in the dollar column.
The portfolio that performs in one economic regime can get crushed in the next. So in this free webinar, we're going to reveal what those 4 economic regimes are, how to identify them, as well as the assets, historically speaking, best positioned to perform in every environment. So reserve your seat now and learn how to prepare your portfolio before the economy shifts again.